When international businesses evaluate potential locations in Europe, Denmark often stands out for its competitive, transparent, and predictable tax environment. And in this video, we will walk through the key elements of the Danish tax system that matter most for companies considering investment or expansion. To begin, it is important to understand the overarching philosophy. Denmark combines a relatively moderate corporate tax rate with a high degree of administrative efficiency, legal stability, and digitalization. The headline corporate income tax rate is currently 22%, which positions Denmark in the mid-range among Western European economies. That rate applies to resident companies on their worldwide income, although double tax treaties and specific domestic rules can limit the effective tax burden on foreign source income. Non-resident entities are generally taxed only on Danish source income, and permanent establishment rules follow familiar international norms, which helps reduce uncertainty for multinational groups. One feature that many businesses find attractive is the broad deductibility of operating expenses and the availability of tax depreciation on fixed assets under relatively clear and predictable rules. Machinery and equipment can typically be depreciated using a declining balance method with pooled assets, and buildings used for business purposes are eligible for straight-line depreciation, albeit at more modest rates. Intangible assets, such as patents and certain acquired intellectual property, can often be amortized for tax purposes, which is particularly relevant for technology and pharmaceutical companies that are active in Denmark's innovation ecosystem. Another important aspect is the treatment of participation income. Under Denmark's participation exemption regime, dividends and capital gains on qualifying shareholdings can be exempt from tax, subject to minimum ownership thresholds and certain anti-avoidance conditions. This framework can significantly reduce tax leakage within corporate groups, and is one of the reasons Denmark is often used as a regional hub, especially when combined with its extensive network of double tax treaties that mitigate or eliminate withholding taxes on cross-border payments. Speaking of withholding taxes, Denmark generally imposes withholding on dividends to foreign shareholders, but the rate can be reduced under tax treaties, or the EU parent-subsidiary directive where applicable. Interest and royalties are in many cases not subject to Danish withholding tax when paid to foreign-related parties in treaty or EU jurisdictions, although there are targeted anti-abuse rules that need to be assessed carefully. It is also important for businesses to understand Denmark's approach to transfer pricing and anti-avoidance. Transfer pricing legislation follows OECD guidelines requiring related party transactions to be conducted at arm's length. Documentation requirements apply to many medium and large groups, and the tax authorities are experienced and data-driven in their audit approach. Denmark also applies general anti-avoidance principles and has implemented key elements of the EU's anti-tax avoidance directives, including interest limitation rules, controlled foreign company rules, and anti-hybrid measures. For groups with significant intra-group financing or complex cross-border structures, an upfront review of these rules is essential to avoid surprises. Beyond corporate income tax, companies operating in Denmark must account for value-added tax, or VAT. The standard VAT rate is 25%, one of the higher rates in Europe, but the system is straightforward, with a broad base and limited reduced rates or exemptions. VAT registration is required once a relatively modest turnover threshold is met, and businesses must charge VAT on most goods and services supplied domestically, while being able to recover input VAT on qualifying business expenses. For export-oriented companies, zero rating of many cross-border supplies and efficient refund mechanisms can mitigate cash flow impacts, but robust invoicing and documentation processes are non-negotiable. Employers should also be aware of Denmark's labor-related taxes and social contributions. While the country is known for high personal income tax rates, the burden is largely on employees rather than employers. Employer Social Security contributions are comparatively low by European standards, consisting mainly of fixed or modest contributions to statutory schemes rather than large percentage payroll taxes. That said, companies must manage obligations related to labor market contributions, workplace insurance, and various mandatory funds. For international assignees and key personnel, Denmark offers a favorable expatriate tax regime. Qualifying high-salary employees and researchers can opt for a flat, reduced tax rate on employment income for a limited period, subject to conditions. This scheme can be a powerful tool in attracting global talent, and employers often integrate it into their mobility and compensation planning. Another area that deserves attention is Denmark's strong focus on innovation and sustainability, supported by targeted tax incentives. While the country does not rely heavily on broad-based tax holidays, it does provide meaningful benefits for research and development activities, including enhanced deductions for qualifying R&D costs, and in some cases, the ability to receive a cash refund for tax losses attributable to R&D in smaller or early-stage companies. In addition, Denmark has implemented tax measures that encourage green transition, such as energy and environmental taxes that can affect high-consumption industries, combined with partial refunds or relief for energy-intensive businesses that meet specific criteria. This creates both a risk and an opportunity. Companies that proactively invest in efficiency and low-carbon technologies can manage their tax exposure more effectively and align their operations with Denmark's ambitious climate agenda. Administrative efficiency is another competitive advantage. The Danish tax administration is highly digital, with online portals enabling registration, filing, and payment for most taxes. Corporate tax returns are generally filed electronically, and the system is integrated with financial reporting requirements, which can reduce duplication of work. For foreign investors, establishing a Danish company or registering a branch is a relatively streamlined process, but it is important to align tax registrations, accounting systems, and internal controls early to avoid penalties or compliance gaps. While penalties in Denmark are not extreme by global standards, the authorities place a premium on timely, accurate reporting and late filings, missing transfer pricing documentation, or errors in VAT returns can lead to financial and reputational costs. From a strategic perspective, the real question for many businesses is how Denmark's tax system fits into their broader European structure. The combination of a moderate corporate tax rate, a robust participation exemption, extensive treaty network, and predictable administration makes Denmark an attractive holding, financing, or operating jurisdiction for groups that value stability over aggressive tax planning. At the same time, the strong rule of law and active enforcement environment mean that structures should be grounded in genuine commercial substance, including local management, decision-making, and, where appropriate, personnel and operational functions. In practice, the most successful investors treat tax as one element of an integrated location strategy, alongside talent availability, infrastructure, and access to the Nordic and broader EU markets. To close, any business considering Denmark should take 3 key steps. First, build a clear baseline understanding of the corporate tax, VAT, and labor tax implications of your intended business model, including permanent establishment risk and group financing flows. Second, evaluate available incentives and regimes, especially participation exemptions, expatriate tax rules, and R&D-related benefits, ensuring they are aligned with genuine operational needs. Third, invest early in high-quality compliance and governance, robust transfer pricing policies, accurate VAT systems, and transparent documentation. By approaching Denmark's tax system in a structured, informed way, companies can not only manage risk, but also unlock meaningful strategic advantages in one of Europe's most stable and business-friendly environments.